So IRR is again, most people are familiar with rate of return or ROI, things of that
Mhm.
nature. The only difference really is return on investment doesn't necessarily mean compounding, right? So if I tell you I got a 20% return, I'm like, well, that's great, but a 20% return over 20 years is
Over
not so
100
great,
years, that's not so good.
right? So IRR is maybe just a slightly more advanced metric that we use and we like to prefer because people are so interested in that compound interest, right? And that's really how you start to create this velocity of money effect and compound your money over time. And it really gets exponential. And that's how we grow wealth for Colony Hills Capital, for our team, but also for our investors.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Bettel. I'm here today with Matt Spagnolo, fund manager at Colony Hills Capital. Matt brings a wealth of expertise in multifamily real estate investments, managing over $600 million in assets. Impressive. Today, we'll dive into the strategic approach to multifamily investments, including how he and his team identifies off-market opportunities, which I'm extremely interested in learning, and deliver incredibly impressive returns. One of the things we're going to dive into today is that Colony Hills boasts a 36% internal rate of return. We're gonna define that for anybody who doesn't know what an IRR, internal rate of return, is, but trust me, it is impressive. So, Matt, welcome to the show, my friend. Thanks for being here.
Josh, thanks for the invite. Super pumped to be here and excited to dive in.
Well, I know that you're going to bring a tremendous amount of wisdom to this podcast. So let's just jump in with a little bit of background, because I'm curious. You know, you seem like a very driven young man. You earned your degree in business and economics. I believe you started in the residential and kind of commercial real estate side, and now you've made your ways to Colony Hills and seem to be doing great things over there. So tell us a little bit about your trajectory and how you arrived at Colony Hills.
Yeah, absolutely. Well, you kind of hit it on the head there, starting with business and economics background. I was always interested in business. My dad runs his own chiropractic business. So I always had kind of my entrepreneurial spirit from him. Then graduated college during COVID, unfortunately. So we ended school a little bit early, but it was that weird in between time where we're like, hey, what do we do? Not a bunch of groups are hiring. And the only thing that I did know after learning from my dad is I didn't want to necessarily work for anybody. So what started that mindset, I got into the stock market a little bit, trading equities and options. And I realized, hey, I can't do this full time. So what can I balance trading with? And I found a lot of people in my area that were super successful. I found a common theme, and I like to search for common themes in successful people. And I found that all of them either owned real estate or were currently in real estate. So was able to schedule a couple of meetings, coffees, lunches, bought them lunch, and just pick their brain. I was like, hey, what led you to where you're at now? And they all kind of common feedback was like, hey, if you want to make money, you want to be successful for yourself, but for your family, start in sales. So they were like, hey, start in sales, whether it's residential, commercial, learn the business, build a network, and then you can kind of take off from there. So that's what I did. Just jumped right in. Parents were like, oh my gosh, you're jumping into a commission only job right out of school. And they thought I was crazy. And I said, look, I've got a 5-year plan. So I jumped in, started to scale my residential and commercial business. And then the team that I joined was actually launching kind of an investment program. So they had the sales side. And then we started flipping homes and obviously wanted to scale into small multis and eventually be kind of a larger corporation. And I realized I was finding deals, underwriting deals, talking to brokers. I was wearing 5 hats. And I realized, hey, you know what? This is too much for me to focus on that and still have a sales career. And kind of being in the right place at the right time. I was at a conference in New Orleans and met my CEO now, Glenn Hansen. And he was talking about Colony Hills Capital and how he scaled it for 15 years and how they're on this launch pad. But what really made him unique was this co-GP vehicle that they have at Colony, or we have at Colony now. And I was really intrigued by that. And I always thought I wanted to be this investor who has hundreds of rentals and landlord and deal, all of that. But he's talking about this co-GP fund and how it allows you to have that ownership and get access to that upside that everybody's looking for, but still have the passivity that everyone's looking for. So I had some mentors early on that flipped over 200 homes in, I think, 3 or 4 years here in Richmond. And
Wow.
one thing that they always said was, oh my God, it's great. I'm wealthy on paper, but my bank account looks empty, and the headaches that I deal with tenants and contractors and things of that nature. He's like, I would probably go a different route. So I kind of found this opportunity with Colony, and Glenn gave me the opportunity to work with him and alongside him, and that's where we're at today, and super pumped. So that's kind of my trajectory.
Great. Thanks for bringing us up to speed. Give us just a 30-second explanation. What is a co-GP model?
Yeah, absolutely. So Colony is a private placement real estate. So most people are familiar with REITs, things of that nature, where you're a passive limited partner. You just invest and you've got a small ownership in a larger company that's buying multifamily. So what Colony does is, instead of going to retail investors for the limited partnership, we go to larger institutions that have their funds that are usually made up of smaller investors. But our vehicle, we create a unique entity or a business that brings in retail investors. So our investors are limited partners in that entity, but then we place that entity into the general partnership on a deal by deal basis. So in multifamily, and we can dive into this in a second, the waterfall structures and how money flows as you hit certain benchmarks, your promotion or your percentage of the return starts to increase if you're a general partner. So that's why groups go into syndication, is because as the property starts to perform, they start to earn outsized returns and a disproportionate share, we like to say, of the return. So you might start with 20% of the equity, but by the final waterfall, you could be receiving up to 50% of that next tranche or distribution of capital. So we give our investors a little piece of that. And investors like it because it diversifies them even further within the syndication space. So they know they want to be in real estate. They have all these syndication investments, and the co-GP vehicle allows them to be even more diversified within that venue or avenue, so to speak.
So my takeaway from that is that you hold your assets in a limited partnership structure.
Correct.
Versus an LLC, which is the same way we hold title. My mom was a landlord tenant attorney and then got into asset protection and did a lot of research that way. And she's always advised us to hold in limited partnerships versus LLCs, and under that same structure, where typically when we do a big commercial deal, we're the general partners. We're qualifying for the loans, or even if it's a non-recourse loan, we're kind of doing all that work, finding the deals, and then we bring in capital partners under limited partner structures. So that's similar to how you guys are operating.
So I want to clarify, we are the operator. So Colony Hills Capital is signing on the notes, things of that nature, but the fund entity itself does not. So the fund doesn't have any of that liability and things of that nature. So there's a separation there. But Colony has full responsibility and liability on a deal by deal basis.
Got it. Okay, I think I'm tracking with you there. Interesting, very interesting. So and I think you answered this. The reason why that co-general partner structure versus just bringing in investors as limited partners is that gives them preferential treatment as it relates to the returns that are paid out over a period of time as GPs for general partners versus limited partners.
Correct. So it just depends on where the money's flowing. Again, we structure each deal a little bit uniquely, but having that entity that they're sitting in sit in the general partnership on a deal by deal basis allows them to get access to that. So when all the money is separated, then there's a separate waterfall, so to speak, between, okay, all this money sitting in the GP, how do we split it between Colony Hills Capital and the fund? And that's a whole nother discussion, but for the general preface, that's how it works.
Okay, great. I understand that. That makes a ton of sense. All right. Well, I want to get into here in a minute the internal rate of return that you guys are able to generate, which is pretty incredible, and see if there's some lessons that we can teach people on your approach to finding properties. But before we go to that, I think we're having this podcast on an interesting day, right? We just heard Fed Chair Jerome Powell at the Jackson Hole Symposium, and this is a pretty famous annual event that policymakers and bankers from all across the world attend. And he signaled, I just finished watching about a 10-minute prepared remarks that he had. And essentially he said, look, inflation got away from us. We've wrangled this bull. It's headed in the right direction, and the job picture is starting to erode a little bit. The number of job openings is starting to contract, and to me, clearly signaled that there's, a change in interest rate trajectory, and that rates are going to be going down as it relates to the Fed funds rate. So I guess I want to talk about two things to make this as educational as possible for people. The first thing I want to talk about is mortgage rates, both in the residential world and the commercial world, are not directly correlated to the Fed funds rate, because the Fed funds
Yep.
rate is an overnight interbank lending rate. But they tend to move in similar directions because they're getting their direction from inflation and the direction of the economy. And when the economy starts to turn over and turn down, when inflation is going down, mortgage rates, commercial rates go down. And interestingly enough, the Fed funds rate tends to be the last one to start turning over and moving down. So what would you
Absolutely.
add to that, Matt? And how does, and the follow-up question to that is, now that we've already seen mortgage rates come down on the residential side from almost 8% to the high sixes. We've seen commercial rates come down at least a full percent. You may tell me even more than that. Now you're seeing the Fed say, now we're going to be cutting the Fed funds rate. So how does that impact your investment philosophy, or maybe your stance as it relates to being aggressive or passive in the market?
Mm-hmm.
So I know that was a lot, but take it away, sir.
Yeah, I think I'll start with kind of your side in terms of the residential. And right after Powell was done speaking, I was watching on CNBC, and they brought the CEO of Compass came on talking about residential, and
Oh,
he
I
said,
didn't see that.
a common misconception is that residential buyers will wait until September to buy, right? They think that, oh my God, I'm going to get a lower interest rate in September when the cut's official, when in reality, to your point, that's already baked in. And
Okay.
he made the point, hey, you know what? This is actually the better time to be buying from now until when that rate cut is, because if everybody's waiting until September, you don't want to be competing against everybody who's jumping into the market in September, right? So you have this month or so window to be aggressive and to maybe have less competition in the residential markets. So that's one thing I did want to highlight is there's not this huge drop on, okay, as soon as Powell decides, hey, we're gonna drop rates, there's not this significant drop that happens in a day, and you're closing in 30 days anyway. So that's one point I wanted to hit on the residential side. For us in the multifamily side and commercial, the only thing that it really changes for us is sometimes our underwriting rates that we are going to underwrite our deals for. And I think volume, in terms of transaction volume, has been down whatever the last 6 to 12 months, so to speak. And I think the main reason is because there's this huge spread between what sellers want for their properties and what we're willing to pay, right? So I think that this drop in interest rates helps narrow that margin, and it's going to create more liquidity in the market. It's going to increase transaction volume. And at the end of the day, sellers, and we can get into kind of how we're buying properties, things of that nature, these sellers are rolling up funds. They need to move money into other assets. So at some point, there comes a time where their loan could be coming due, where we're there to snag it. But for us, it's maybe just changing our underwriting on maybe interest rate projections. Again, we only do really fixed rate, Fannie Freddie debt. But for us, it's maybe just changing things on the underwriting side and maybe improving our purchase price, because rates are coming down and we have a significant spread there. So that's really what's changing on our end, but wanted to hit the residential and multifamily space.
Great answer. Yeah, I mean, we might have been, we're trying to thread the needle, in our business, in our investment business. We made the decision to sell one of our smaller properties this week and having no 1031 exchange opportunity identified. But my thesis is there's going to be this kind of moment where there's peak pain in the commercial market, where some of these sellers have been trying to get a higher price, but because of where interest rates are, they haven't been able to get that price. And my hope is that, end of the third quarter, first of the fourth quarter, they start to capitulate a little bit and be like, all right, let's get this thing sold by the end of the year, right as mortgage rates are turning down. So in my real estate business, we've decided to sell two of our smaller properties. We already have one property contracted. We're going to 1031, but to sell another property without something identified is a bit of the technical term would be ballsy move. Because, I was talking to Matt before we got rolling. We've gone the last 2 years and haven't been able to find a single commercial deal that really made sense other than the one we have under contract right now. So there's a lot of upside tax exposure if we sell this property and can't 1031 in. So first question, Matt, do you think my thesis is right? And are you guys doing anything similar as to your kind of positioning towards the fourth quarter?
Yeah, great question. I think your thesis is correct. And the way that Colony takes our approach is it's very, very hard to time the top or the bottom of any market cycle. So I think a common phrase amongst a lot of, I'm not a financial advisor, but a lot of financial advisors say time in the market versus timing the market. And for us, we want to be buyers at all times. And obviously we want to try to buy more when it's a buyer's market and sell more when it's a seller's market. So for us, there's a couple properties in our portfolio that we are looking to exit. But again, if we feel that, hey, there's not much more value add we have at the actual property level, and we're really subject to market valuations and interest rates, things of that nature. Hey, if our thesis is that, hey, over the next 6 to 18 months, we're going to see a drop in interest rates, that's going to increase the value of those properties significantly without us improving the actual bottom line at the property level. But for us, again, we believe in buying in multiple market cycles. You're not going to be able to time the top or the bottom. And to your point, I think a lot of people that got in very low interest rates right after COVID, that 5 year, a lot of those commercial loans are 5 year terms. Those 5 years are coming up here in 2025. So that's going to be interesting for us. Again, some asset classes are performing very differently than others in terms of real estate, office, industrial, multifamily. Everybody's in a different space. But I think 2025 is going to be an exciting year for opportunity for us. And I think we're definitely still active buyers for the next 6 to 18 months.
Great. Good answer. Okay. So by the way, what asset classes are you guys invested in right now? Where are you focused? Where do you see the most opportunity?
Absolutely. So at Colony, we focus strictly on what we've been good at since inception, which is garden style, value add, core plus multifamily, usually class.
Define core plus for our listeners.
Yeah, so we usually like to say there's kind of the new construction, which are properties that are built in the last 6 to 12 months. And then slightly below that is core plus, which are deals that are 5 to 10, 15 years older. There's not a ton of value add in terms of the units. The interiors look very similar to the new construction. So there's less risk and things of that nature. So as you go down the spectrum, the deals get riskier, but also have higher potential upside, right? Risk return, things of that nature. So we don't do any new construction. We don't do development. So we buy sometimes slightly below that if we can get a really good cost basis. And then slightly below that is value add, where the properties need significant renovations on the interiors, amenities, a full refurbishing. And then below that is either distressed or opportunistic. We don't really play in that space. I think the risk reward it's very risky, but the upside is there. We want to play in this in between game. And we find that those value add and core plus deals are as close to recession proof as you can get in multifamily. But yeah, that's where we're buying. Again, in markets for us, that's kind of the hot topic right now is where is everybody buying? Where's kind of the next Sun Belt, right? I think everybody is either, sometimes the new sponsors are, everybody's hearing, hey, I need to be in the Sun Belt, I need to be in the Southeast. And to be honest with you, we're actually maybe a first mover out of the Southeast. I think the Southeast is getting a lot of new construction units. We think that there's a lot of saturation of sponsors, so deals are getting bid up from the start. And that combination is something that we don't want to play with. As well as there's certain markets in the Southeast, especially Florida, markets like Houston, insurance is basically underwritable. And property taxes are going up in some of these states too. So some of those uncontrollable factors for us, we're underwriting too. And if a deal is there, we'll still go after it. But we're actually moving to some markets maybe in the Northeast that have gotten overlooked, and we're buying discounts up there. So to your point about finding good discounted off-market deals, we like to be ahead of the curve versus just following the trend of what everybody's saying on social media and things of that nature. So that's a little bit more about our thesis, and we can get into that. But that was kind of my answer to your question.
Great. So let's talk a little bit about, one of the things that struck me was this 36% IRR. So first of all, let's define what an IRR is, and then let's talk a little bit about how you achieve that. And then I want to talk from there, a little bit about how that plays into the rule of 72. And, if you can compound your returns on your investment at 36%, that means you're doubling your investments every 2 years. And we can get into that. I'll define that and explain the math on that a little bit later. But let's start with what is an IRR? Let's break that down. And then how the heck are you guys getting that kind of return? And over what time period is that? I'd love to know.
Yeah, absolutely. Great question. So IRR is again, most people are familiar with rate of return or ROI, things of that nature. The only difference really is return on investment doesn't necessarily mean compounding, right? So if I tell you I got a 20% return, I'm like, well, that's great, but a 20% return over 20 years is
For
not so
100
great.
years, that's not so good.
Right? So IRR is maybe just a slightly more advanced metric that we use and we like to prefer because people are so interested in that compound interest, right? And that's really how you start to create this velocity of money effect and compound your money over time. And it really gets exponential. And that's how we grow wealth for Colony Hills Capital, for our team, but also for our investors. Again, everybody's shooting for that generational wealth, and compounding your money over time is the best way to do it, to your point. So IRR really is just compounding year over year. So instead of saying, hey, we earned 36% ROI over 5 years, 36% IRR would be the equivalent of earning 36% year one, 36% year two, 36% year three, and the proceeds from each of those years compounding on each other. So it doesn't necessarily happen that way with the way that we do it. We make most of our money on the sale, being in multifamily and value add. But when you average that out over the time frame of a hold, that's what it averages out to.
Yeah, and real estate is so hard to figure out your total return because it's a multi-dimensional asset, and that just means you get paid in different ways as an investor. So, the way most people would calculate maybe a return on investment would be, hey, I put $100,000 on a down payment on this property, and I made $7,000 in cash flow. Okay, well, that's a $7,000 cash on cash return, or 7% cash on cash return. But that's just one of the ways that investor would get paid. There's an amortization. So the mortgage balance might go down 3% that year. So that is also calculated into an internal rate of return. And then, as you were mentioning, Matt, on the exit, let's just say the exit is a sale versus a refinance or something like that. If the property has appreciated and then they get a kicker because the value went up, plus the mortgage went down, plus the cash flow that was distributed over that period of time, then you have to say, okay, at the end of that 10-year period, which is usually what an IRR is calculated over, at the end of that period, if we add all the different ways that investors were paid, what is that total return annualized over that 10 years? And you say, oh, that's an internal rate of return of 36%, which is extraordinarily high. So then my next question is, how the hell are you guys getting that return? And where can I get some of that secret sauce?
Yeah, absolutely. So Colony has done over 36 transactions, and of those 36, 10 have gone full cycle. And I think we talked before about defining full cycle. For us, those 10 full cycle means we purchased and have exited. So of the 36 transactions, there's some that we assigned for a fee, and there's obviously some that are still in our portfolio. But of the 10 that have gone full cycle, and they've ranged everywhere from 10 or $15 million acquisitions to our latest acquisition was $130 million. So Colony is continuing to grow in terms of the deal size. But one thing has remained consistent. One, I think it starts with our strategy, right? So garden style value add, this A- to maybe C+ class properties. And because we've stuck with that strategy, brokers, sellers all know exactly what we're looking for. So it starts with our leadership, and Glenn Hansen, our CEO, and David Kaufman, our CIO. They've got over 30 years of multifamily and business experience. So they have deep rooted relationships with not only the brokers, but even sometimes direct to seller, where these larger institutions, it can be funds, it can be large banks. They might be looking to roll up a fund. They could have a loan coming due. And if the property's maybe not performing exactly how they wanted to, or they're maybe forced to sell at a time that they don't want to, hence the market cycles, they still have to sell because that loan's coming due or the fund is ending and they need to return capital to their investors. So we've we like to say that we're more snipers than machine gunners. So Colony's not this large institution doing hundreds of deals a year, things of that nature. We're finding anywhere between 2 to 6 deals a year that we really like for our underwriting. And we really are underwriting on a 5-year hold. So we're projecting a 5-year hold, and
Okay.
we won't acquire a deal unless we can underwrite to a 20 plus IRR on a 5-year hold and an average 6 to 7% cash on cash or yield over that 5-year period. So we take that projection, right, or underwriting. How are we able to outperform? How historically have we been able to outperform that? Is because when you take that IRR over a 5-year period, if you shrink it to 3 years, you're going to get an increase in IRR because you're not spreading that over 5 years. If
Yep.
you can have the same value creation in 3 years and exit, your IRR is going to be higher because you're shortening that time frame. And because of our strategy, we are increasing the most value on the front end, right? So we are renovating units, we're improving amenities, we're building new clubhouses in that first year to 2 years. And then that second and a half, increasing the bottom line, the operating income at the property. And then by year 3 is when we want to have that property stabilized, occupancies back up to 95+%. And then at that point, the diminishing returns start to occur, right? We're not improving any more value. We're not increasing rents significantly. If market appreciation happens, that's great, but we're not baking that in. Our strategy at Colony is to simply find the spread between what market rents are and where rents are currently. So we want to go in day one, and we're not projecting a 10% increase in market rents over the next 5 years or in the next 2 years. We are only improving properties to get back to market and capturing what we call loss to lease. So if the property next door is charging $1,500 a month in rent, we want to buy properties that are charging $1,100 or $1,200. So through improving amenities, improving units, we want to get right back up to where that neighboring property is. And then anything on top of that is just gravy. So we're finding properties that fit that criteria. And then our general hold period is 2 to 4 years. So we're shrinking that time frame and achieving that higher IRR than our projections.
So there's some lessons in here for beginning investors, right? So you could do the same thing that Matt's just explaining and exercise that strategy with a duplex, right? And so let me break it down for a duplex. You are out searching for properties, and pretend you're a renter and you're out looking for a place to rent. And you're looking at a bunch of duplexes or triplexes or fourplexes or whatever, small units. And you see, okay, the going rent for this class, this age, in good shape, they're going for $1,400-$1,500. And then all of a sudden you stumble upon a duplex that has probably similar bones, but likely more deferred maintenance and some sort of what they call functional obsolescence, something that is less desirable about the property. And they're at $1,100 a month. Well, what Matt's explaining to you is your opportunity is taking that property from $1,100 a month to $1,500 a month. And when you do that at scale with large numbers of units, it's an extraordinary rate of return because these properties sell based off of cash flow, future cash flow expectations called cap rates. And if you can raise that rent $400 a door, it really increases the value of the property. So you can take the lesson that Matt's teaching you. And if you're a first time, the last podcast I did, Matt, was with a guy named Jesse. Boy, I wish I could remember his last name. He's such a stud. We'll put it in the show notes. And it was all about house hacking. And, so if you're a first-time buyer thinking about house hacking, you could take those lessons from Jesse as it relates to house hacking and layer on top of what Matt is teaching us. Don't go buy the duplex or the property with a mother-in-law or an accessory dwelling unit that's at the top of the rent range. Find one, Jesse Ray, that's right. Find one that is in that lower end of rents, and then the way you increase the value of the property is improving it and then re-renting it at a higher amount. So those are great lessons, and combined together, I think, are really powerful.
Absolutely, yeah. And to just hit on the house hacking point, I think that's a great way to start, right? You can't just dive right into doing 400 unit apartment complexes. And I think everybody initially starts with doing it themselves. And obviously you can go, we talked before about going different routes, right? being the owner operator yourself or kind of the passive route, things of that nature with our fund. Depends on your time, your energy, and financial capabilities, things of that nature. But no, I think house hacking is a great way to start. And I think to your point, that's the best way to do it, through renovations, adding value, building in that equity, right, into the property. You don't see it right away in your bank account, but it's definitely sitting there. And I think house hacking is a great way to start.
So, Matt, why exit? Why not hold on to those properties forever? If you've taken it from 11, I love this avatar. We've taken it from $1,100 a month, and presumably at $1,100 a month, the deal was okay. Not a great buy, but it was okay. But once you got it to $1,500 a month, and you're only into it for your acquisition cost plus your fix-ups, presumably your cash flow on that property is pretty fantastic. So why exit rather than just stay in that thing forever? Perhaps refinance at the next cycle, get some of your capital back out for your renovations, and hold longer. What's the thinking behind the strategy is what I'm trying to understand.
Yeah, well, that's a great question. And I think it's a common question amongst investors. And everybody sees the YouTube videos and the TikToks of the BRRRR strategy, right? Buy, renovate, refinance, things of that nature. So people are like, why aren't you doing that with apartment complexes? And we certainly can. But our strategy, and when you're investing in any vehicle, right, you can go either the growth or you can go the income avenue. And sometimes there's avenues that are in the middle. We are probably as far to the growth side as you can get, right? So our investors are looking to turn their capital over, the compound effect, like you said. And instead of that 36 IRR, if we were to hold it, refinance, that time frame starts to widen out. And if you get 15-20% for 20 years, that's phenomenal. But we want to be able to turn properties over. We believe in the velocity of money effect, getting money back to you, putting it in the next vehicle, and creating this sort of flywheel effect, whether it's with our fund or any other investment, but getting it back to the investors so that they can make the decision to move forward with it how they want. And for us, it's really that value add starts to diminish after year 3. So if yes, the cash flow can be great, but also to your point, there could be loans coming due depending on if we get a 5-year loan, 10-year loan. But for us, we want to create that flywheel effect with our investors and invest in our next deal or our next vehicle.
So, okay, so take Matt's exact philosophy that he's doing at scale with commercial properties and apply this back to anything from a single family residence to a duplex to smaller units, right? Because, Matt, what I'm really focused on with this podcast in the year ahead is there's this massive gap in wealth between, and I've got a chart I could show you, but, the bottom 50% of Americans, 50% of households in America. So that'd be a cohort of approximately 175 million Americans. They only control, there we go, 3 fingers, left hand. It's hard to control. All right, it's Friday. Like, wait, there should be 3. They only control 3% of the wealth in the United States. That is if that's not a mind screw, I don't know what is, right? Because that means the other 175 million Americans control 97% of the wealth. It gets weirder. It gets more curious. It gets more problematic, really. If you go up to 90% of America, right? So this is from the bottom up to the 90th percentile as it relates to household wealth, which would be a cohort of 315 million Americans. They only control 34% of the wealth in the United States, which means then that the top 10%, a cohort of 35 million, control 66% of the wealth in America. And so, one of the things I'm focused on is that opportunity that lies with helping that bottom 90%. And that means taking these lessons that you and I are thinking about at a high level and then bringing them back down to, cool, how does the millennial or Gen Z, like my kid, get a foothold into this wealth hierarchy, right? And so I'm always trying to bring the lessons that you're teaching down. So look, the moral of this story is, if you're looking to buy a single family home or a home with an accessory dwelling unit or a duplex, and you're trying to get in, the lesson that Matt is telling you here is buy the property that is rented that currently, if you have multi-units like a duplex or triplex or something, buy something that has below market rents. There's opportunity to increase the rents. That's lesson one. Lesson two, he's telling you that he's getting a 36% internal rate of return because he's increasing the rents, selling, and then taking that cash flow, 1031 exchanging, or if you're an owner occupant in one of them and your capital gains and you're married is less than 500K, you can move it tax-free. But don't spend that wealth. Take that wealth, move it into the next property, and do it again. So what his lesson here is: the faster you can increase the rents, sell the property at a higher, and move to the next one, the higher the rate of return is what he's figured out. Anything you'd add to that, Matt?
No, I think you hit the nail on the head. And the only other point that I would make, and part of why I fell in love with real estate is the scalability. To your point, the same strategy that we can do with a $150 million apartment complex, 500 plus units, is the same thing you can do even on a primary residence. I know you gave the example of a duplex earlier, but I think people so much fall in love with buying that newly renovated house, or they buy the property at its peak value. Do the opposite. There's so many avenues, and you can people say use other people's money. There's so many either government loans or things of that nature that will actually provide you the capital you need to renovate your house, right? So I think the lesson here is, even at a primary residence, if you're going to buy your starter home, don't buy that house that was just renovated by the seller or probably somebody who's flipping the house, right? Buy the house that needs the work. One, you'll probably get some enjoyment out of it, but you don't have to have the capital yourself. There are so many programs out there that will allow you to renovate your property. And then it starts with your single family home or your primary residence, right? And then maybe do a duplex. So I think it scales so well. To your point, you can take the lessons from a large apartment complex and apply it to the everyday house, a $200,000 home.
Yeah, super well said. So I want to talk a little bit, and you alluded to this, and so maybe you already answered this question, but the other thing that I thought was interesting was how you talk about having identifying off-market properties. So is that just through a network and team? And are there any lessons there that are, somewhat universal that someone down the ladder buying smaller units could learn from that same lesson?
Yeah, I think it starts with relationships, and I think I hit this at the beginning, or hinted to it at least. Is it starts with your network. I actually started a networking group when I was first in my sales career, called the Net Worth Network, and our motto was basically that your net worth was only as large as your network, right? How close are you to somebody else? And that's what it's all about, is really starting to develop a brand, or getting your name out there, so when people hear your name, they know exactly what you do, how to reach you. And things of that nature. So I think the biggest lesson really is building those relationships, but not just day one, right? Not just having a good first connection, but continuing those relationships. There's a woman that has been a great referral source for me recently. We met at a conference in New York, and it's just those 5-minute conversations. Hey, I don't need anything from you. You don't need anything from me, but how are you? How's your business? How can I provide value to you? And I found that talking to a lot of these high net worth individuals and other investors and partners that we have is never start with the ask, but always provide value to them first, and then ask for what you want. Or they'll come to you, okay, what can I help you with now? So provide value first, and then you'll get what you want on the back end. So sometimes I'm at these conferences and people run up to me and they're just pitching their software or their partnership, and oh my God, you guys should come and do deals with us. And it's so, I don't know, such a turn off from the first minute that you talk to me, versus this girl came up to me and she's like, hey, how can I help your business? She came up to me, no self-interest at all. What can you do? Who are you looking to meet? Who can I introduce you to? Next thing you know, boom, boom, boom. She introduces me to 3 people that we've partnered with. Right.
That's great.
And now I'm reaching out to her and be like, what can I do for you?
Yeah, exactly.
And it's so much easier. So again, I want to bring it back to the off-market deals, but it's those relationships that our CEO and CIO have built over 30 years. And again, the compounding effect of your network is the same thing with real estate. And you build this massive web, and I forget what they say, how many degrees of separation you are from somebody. But when you're able to make 1 or 2 phone calls and get connected to somebody that you've never known with a warm introduction, it gets a lot easier to do deals, especially when you've got a great reputation. And brokers and sellers know you can close on time, you've got the cash available, and you're always looking to buy. That's a great reputation. So it starts with reputation, but building that network and building that community is really the key to our success.
And bringing that back to, smaller investors and people just getting started, the team that you have around you. So what is a team? Well, a team is a great realtor. A team is a great mortgage person. Those people see deals. They see opportunities. They're out there all the time. So make relationships with those people and
Mhm.
think of it as an actual relationship. Like investors have to have great. And if you're a wannabe investor, you're just getting started, you have to have a great mortgage person. You have to have a great realtor. And ideally, that realtor is an investor too. See, if you can find a realtor who is an investor and they're farther along in their investor journey, you can adopt their team and you can learn a lot from them. You get a realtor and a mentor at the same time. So if you want to be an investor, find a mortgage lender who owns investment properties and can teach you things like internal rate of returns and how you should be thinking about not only just the cash flow, but your amortization. Like you want someone who speaks investor lingo and has traveled the path
Mhm.
that you're trying to path, and then do the exact same thing with the realtor. And then by extension, when you do business with those folks, you go, oh, by the way, who's the best roofer who can, not screw me on this leak that I have in my ceiling, and who can come out and take care of HVAC without, bending me over. So network is huge. And it starts right from your realtor and your mortgage lender to start to build those. And over time, like you said, you build a reputation and you build a team, and then you can scale. It just takes a little bit of time, but it's worth those relationships are absolutely worth the invest in.
Yeah, one point I just want to follow up on that, and again, it depends on where you are, right? If you've got this reputation of, I mentioned the mentors I had who flipped 200 homes in just a few years. They slowly built that reputation, but they got to the point where agents and wholesalers were sending them deals. They're the only person that they sent a deal to because they knew their criteria and
Yep.
things of that nature. But if you're trying to compete against them, if you find a deal from a wholesaler or a broker, that top group's probably already passed on it, right? So how can you level the playing field? How can you get the great deals that they're getting? You have to create additional incentive for that wholesaler or that agent. And to your point, whether it's, hey, you know what, I'll give the wholesaler his fee up front, but also I'll give you 10% on the back end or 15%, or you have to create additional incentive besides what they're already getting with the other group. And that's what these flippers did is they took the wholesalers, said, hey, we'll pay you a fee up front, but also we'll give you 20% on the back end if you send us your best deals. And as a wholesaler, your eyes light up and you're like, oh my God, I've got,
Win-win.
they're running the show. I get some on the back end and I get my money up front. Why would I send a deal to somebody who's a first time flipper who's just going to pay me probably even less of a fee than they are? And you have to put yourself in the broker or the wholesaler shoes, right? And see what's more attractive to me. If when I was in the brokerage side, I'm not going to a first time investor if I've got this hot property, I know it's going to last a week. I'm going to the person who can close in 7 days and has done it 50 times.
Yeah.
Right. So you have to put yourself in their shoes and create additional incentive if you don't have that reputation. So at least to get started.
It's awesome, man. Great. Appreciate that. Very valuable lessons there. Matt, I want to give you kind of a closing question or thought. And a question that I like to ask many times is, what is a sacred cow, a belief that you see out there amongst investors that you have come to understand is not necessarily true, but is widely accepted as true? So is there something out there, like, I'll give you an example of one just to make sure I'm clear. Like, I hear a lot of people saying, well, I want to get out of debt at all costs. And you're like, okay, well, there's a difference between good debt and bad debt, right? So is there something like that comes to mind to you that is widely believed, perhaps by the 90% that only control a third of the wealth, that is not believed by the top 10% that you could share some wisdom on?
The debt piece is a good one, but it sounds like you've maybe hit on that before. I'll go a different route, and maybe this is more of a personal belief, but I think you hear from a lot of financial advisors say, put your money in the S&P 500, and that's kind of your best risk-adjusted return. And I've through research and learning just about the way the markets work, that's a great way to just be average, right? I think that's a great way to get to retirement and not be in that higher end class. If you want to be in the middle and be just like everybody else, I think that's a great way to do that. and that's fine. There's nothing wrong with that. There's some people that don't have the education or don't want more than that, and that's fine. But before I got into real estate, before I graduated, I had an internship with a financial advising firm, and they run these projections and the compound returns, things of that nature of the S&P 500. But you start subtracting inflation, or you start subtracting what they say is inflation, at least your portfolio grows really at the same value that your money is depreciating. And the number that they say about inflation isn't always true. I think it changes, and they pull things in and out. But at the end of the day, if you're just pacing the market, you're going to be just like everybody else, and you're not going to be in that top tier. If you want to get to that next level, I think you have to look outside of that. And another thing that's coming to light here is a lot of private investments, like what we do, are only open to accredited investors, and there's a whole criteria for that. And I thought, why are our investments only available to a select number of affluent people? And I was like, that doesn't make sense. And I believe the SEC recently just passed a law that they're creating a test or an exam that you can pass. Basically, what they were trying to do is our investments are maybe more risky, or they're not as regulated as equities or REITs. But they are basically providing this exam to investors that allow them to pass this exam and basically become an accredited investor through an exam versus a financial requirement. And I think this is going to open up a world to let the average Joe and the person who doesn't meet the accredited investor criteria to have access to some of these private investments. So I encourage people to do their own research, learn, create an edge, create some sort of alpha. But again, I think once you find the return of the S&P 500, you subtract inflation, and obviously the dips in the market and people getting in and out. I think you need to look elsewhere and to find groups that are doing it at a higher rate. So that's kind of my answer to your question.
It's a great answer. And you, unbeknownst to you, you just started speaking my love language, which was understanding the difference between real and nominal returns.
Yep.
So I'm going to define the difference between real and nominal, because everybody needs to understand that, unless you like being uncomfortably having an uncomfortable amount of wealth. Like if you don't understand the difference between real and nominal, it is almost impossible to become really wealthy. So because
Absolutely.
You're speaking my love language, let's back this up with a few slides. So this is essentially what Matt's talking about, but I'm just going to show it visually for those of you that are listening on a podcast. Go to YouTube. So 1913 is when the Federal Reserve was formed. And from 1913, let's just call it to 1970. Let's just use round numbers. So roughly 60 years. You saw cumulative inflation of 284%. Now that sounds like a lot, but if you think about it, over 60 years, it really only means that the price of things are doubling every 20 years. It's not that big of a deal, right? Your 5-cent piece of bubble gum 20 years later costs 10 cents. It is eroding the value of your dollar, but at a reasonable pace. Well, unfortunately, or a manageable pace, maybe I should say. Unfortunately, 1971, Nixon closes the gold window. The US dollar officially becomes a fiat currency, which means it is no longer backed by any kind of commodity like gold or oil. And that means that you can just, the Federal Reserve can just print dollars into circulation at that point. The Treasury is no longer bound by how many dollars they can borrow. You see the national debt explode right about this time, and you end up debasing the currency, meaning you're increasing the number of dollars in the system faster than you are increasing the economic engine, or faster than GDP, gross domestic product, is growing. And when you take a pie that is cut up into 8 pieces, and then all of a sudden you cut it into 16 pieces, you don't have any more pie, you just have more pieces of pie. And that's essentially what happened. And you saw massive inflation starting in 1971. So from 1970, in this picture, it's actually December 69, let's just call it 1970 through 22. So now we got 52 years, but you don't have 284% in inflation, you have another 2,600% in inflation, which means your piece of pie just got cut into not 16 pieces, but like 64 pieces, right? So I'll show you just one other really kind of crazy slide around here that, I mean, when people understand this, it just blows their mind. So if you go back and you say, okay, in 1913, when the Fed was formed, and you take the value of $100 bill, you see, in 1913 and in 2024, we called a $100 bill a $100 bill. So in nominal terms, name alone, a $100 bill is a $100 bill. But in real terms, adjusted for inflation, meaning what is your real buying power, which is what Matt was discussing, that over that period of time, there's been over, because this goes to 2023, the previous slide only went 2022, there was 3,015% cumulative inflation over that 110-year period of time, which means that if you had saved that $100 bill over that period of time, you only had $3.20 worth of buying power in 2023. It's absolutely incredible. And so as you're looking at these compound returns of the S&P, which financial advisors like to show, they're showing your future value of, oh my gosh, you're going to have $10 million in retirement. And that seems like a lot of money. Unfortunately, retirement's 40 years away, and $10 million is not a lot of money in 40 years because of inflation. So what Matt's alluding to here is, look, real estate is an inflation hedged investment, because as inflation erodes the value of the dollar, rents go up over time. There's a whole nother, we've done podcasts on this, but also over long periods of time, inflation essentially devalues debt. Jason Hartman taught me this strategy. Do you know Jason Hartman, Matt? Have you ever stumbled onto that name?
No, I don't have to look into him.
Do Google inflation-induced debt destruction by Jason Hartman. This dude is a brilliant thinker, and essentially, what he showed in very systematic, broken down with mathematical, showing you an amortization chart, is how over time inflation not only erodes the value of the dollar, but it also erodes the value of dollar-denominated debt. So the value of the debt on a property goes down as inflation goes up because it pushes rents up. Anyways, Google inflation-induced debt destruction if you're interested in more in that. But what you just said to close us out here, Matt, was incredibly valuable. So thank you for coming on and sharing so generously with us. How can people find you and find out more about your firm?
Yeah, absolutely. Well, again, work for Colony Hills Capital. You can just search us on Google or go to our website. We've got tons of more information about how Colony works and our fund. We talked a lot about IRR, things of that nature. We actually put an IRR calculator onto our website. Again, we have projections, and you can kind of do a sensitivity matrix, so to speak. Say, okay, we underperform and we're only at a 10% IRR. What would my return be? And okay, we do exceed expectations and we're at a 36 IRR. It allows you to really see those the margins there and what the difference might be. So encourage you to check us out. Again, Josh, appreciate you for having me on, and I would love to keep the conversation going and provide value to you any way that I can.
Thanks a lot, Matt. It's a wrap, everybody. We'll see you on the next episode.